Hey, good afternoon. I want to take this opportunity to welcome everybody to today's sneak preview Q4 earnings. It's Wednesday, January 17th. We've got John Hopkins here. Tom Bowley going to jump in just a minute. Hey, if you happen to be new to Earnings Beats, of course, I want to welcome you. Appreciate you taking the time to give us a try. Of course, want to also welcome our wonderful subscribers. Appreciate you also taking the time to stop by today. As usual, this webinar will be recorded. You'll be able to listen to it at your leisure. For some reason you have to leave, no sweat. We'll make sure you get a copy sometime later today. This is the second of 3 webinars this week. Yesterday was our Max Payne webinar. Tomorrow we've got I believe, an ETF related webinar. So, all right, Tom, you got to get to this one. You have one more tomorrow. You still got some voice left? I'm not sure he does.
I do. I just had to find the right tab
Okay.
to back into the room so I could turn my mic on.
I
No, I'm
literally thought you
here.
lost the voice.
Nope. Still got some voice left.
Okay, well, you know what? I'm going to step aside so you can jump right into this thing.
All right, sounds good. Welcome everybody. I'll try to go through this pretty quickly. I know everybody's got some things they need to do in the evening, and I do want to welcome a lot of folks maybe that are new to Earnings Beats. We do a lot of research for our members, and certainly earnings is one of those areas where we get really deeply involved and try to just find whatever we can that can help from a trading perspective. And this is one of those. I think earnings, being a CPA and being in public accounting for many years, I can tell you that there's really only 2 things that really drive stock prices over time. One is interest rates, and the other is earnings. I mean, if you can figure those 2 things out, you're going to be a leg up on everybody in terms of which way the stock market's going to go. Lower interest rates, with everything else being equal, means higher valuations. Higher interest rates with everything being equal means lower valuations. It's pretty simple when you do valuations, because you're taking future earnings and you're discounting back using interest rates. And so if the interest rates are going up, those future earnings actually get discounted more, and the value of those earnings is less. And when interest rates are down, those future earnings actually get discounted back with using lower interest rates, and the values are much higher. So valuations are generally going to be higher as a result. So if interest rates are going up and down, it does have an impact on the long-term direction of the S&P 500 and all the major indices. So that part's pretty clear. The other part that's pretty clear is earnings. I mean, if you think about what's going to drive a company's value over time, it's going to be what they produce for their shareholders. I mean, that is another one I think is pretty easy to kind of wrap your hands around. And when I go through this presentation, I want you to keep in mind that a lot of folks are always trying to value the S&P 500 and always talking. I mean, just about every quarter you go into, you hear about the fact that the market's not going to live up to its earnings expectations. I mean, everybody, I'm sure, has heard that. And you hear it over and over again, and just about before every earnings season. Well, it just doesn't look like a good quarter for earnings. Well, I can tell you from doing research, if you go over to S&P Global or SP Global, and I'm going to show you an article today talking a little bit about Q3 earnings, which was last quarter, before we talk about this quarter. But historically, roughly about 65 to 67% of companies beat their earnings expectations. Two-thirds of companies beat their earnings expectations going back many, many, many years. And yet you'll hear folks talk about, well, earnings aren't going to be up to par this quarter, or next quarter they're not going to be up to par. They're always up to par. And par is the consensus estimates that are out there. When companies beat, if they can consistently beat, their price is going to go up. Apple, obviously a great example, one of the best companies ever. But they just continually outperform their competition. The innovation at that company is outrageous. Their customer service is great. And they continue to return great profits for their shareholders quarter after quarter, year after year, and even decade after decade. And that's what drives a major advance higher. So if you can find companies that are steadily growing their earnings, you got a pretty good chance to find some companies that'll be great performers in your portfolio. But here we are now going into the next quarter, quarter four. We've just kicked off earnings season. Yeah, some of the numbers have been mixed, but for the most part, we're seeing better than expected earnings. I mean, earnings again are coming in ahead of expectations. And that bodes well for stock prices eventually. You know, it doesn't mean that every single day the market's going to go up because earnings have been great. You're going to get the movement back and forth. You got a market making system. Of course, that's going to drive prices all over the place. And from an emotional perspective, a lot of folks don't deal with it well, and they tend to chase. They either chase to the upside in terms of buying, and then when the market's going down, they chase to the downside in terms of selling and getting out. And that's usually the opposite of what we want to be doing. So anyway, what I'm going to do tonight or today, this afternoon, and again, I'll try to go through this as quickly as possible. I'd love to be out of here in about 45 minutes. That's my goal, 5:15. I'm going to go through and show you Q3 results on a spreadsheet. I track them. I look at companies that I have forecast, thinking that these are companies that are going to beat estimates. These are companies that are going to miss estimates. And then I come back and I show you the results. And so we're going to start off with that results from Q3. Then I'm going to show you that S&P Global article and just kind of point out some interesting facts from an article that's over at their website. It's a great site to check out earnings. If you're really interested in digging into earnings and results that we've had from earnings, that's a great website. So we'll go over there and look at that. Then I'm going to go into Q4 results so far. I mean, we had earnings kickoff last Friday. I mean, really, we've had some earnings kickoff before that, but last Friday was that's the day everybody points to because that's when we get JP Morgan, we get Citigroup, Bank of America, Wells Fargo, some of the really big money central banks. And then we've got, I think UNH reported, United Health Group reported last Friday as well. So that's kind of viewed as the day that earnings season kicked off. But we've actually had some other reports that have come out earlier. I'm going to go through maybe a dozen or so that I really have liked. These are companies that are going to be added to our strong earnings chart list the next time I update, which should be this weekend. And I'll go over those with you. And then what we're going to do is we're going to take a look at I'm not going to look at all of them, but of the companies that will be reporting between now and when we do the actual Q3 earnings webinar next Wednesday, I'm going to be looking at companies that are going to be reporting over the next week. And I'm going to point out to you ahead of time which ones I think are going to come out with strong numbers and which ones I'm a little bit more concerned about. And then we'll kind of go from there. But that should kind of wrap up what we want to do today. So we're not going to be spending a whole lot of time on all of this. Like I said, hopefully let's shoot for 5:15. I know I can be long-winded, but I'm really going to try to shoot for 5:15 to get all this done. So first thing I want to do is let's move back over, and I will start off by taking a look at what happened last quarter. All right, here's an Excel spreadsheet. So what I like to do, and this would have been, at the Q3 sneak preview. So the event that I did 3 months ago for the public, just kind of looking at the Q3 sneak preview. I think it may have been a little bit later in the quarter because I had more non-banks that I had looked at. This one is going to be a lot of banks because that's what really is going to be reporting. A big percentage of the companies that report over the next week will be banks. But anyway, looking back at Q3 at the sneak preview, I went through, and these were all the companies first that I said, showed really positive relative strength, and I thought would come out with some pretty good numbers. And here were the results. So actual revenues versus estimated revenues, actual EPS versus estimate EPS. Not really going to go into how they performed. That's not really the exercise in what we're trying to do here. What I'm trying to do is to look at these charts and look at their relative strength and decide if I think they have a better than average chance of reporting strong results, beating estimates in terms of both revenues and EPS. That's what the whole goal is. And so this was Q3 sneak preview, again, about 3 months ago. And this is how they came up. I went through the next week, which actually I think we did do this a week later last quarter, because the sneak preview was looking from the 23rd to about the 26th. So we actually looked at that week. And what we found was, of the 33 companies that I thought would be strong, 23 of them beat revenues, 8 missed revenues, 2 matched revenues. So actually 23 plus 2, 25 either matched or beat revenue estimates. Only 8 missed. 21 companies of the 33 beat both, and 0 missed both. So out of the 31, and if we look at the EPS, that was all revenues. If we look at the EPS only, 31 out of the 33 beat earnings estimates, 2 matched, not 1 missed. Now that was crazy. If we go into, well, that was the positive. Let me go over the negative. So here were the negatives. 25 beat earnings, 16 missed though. So look at that ratio there, 25 to 16. Beat versus missed. The good ones were 23 versus 8. So the relationship, there's obviously a higher percentage we're beating based on relative strength. And then down here with the ones that weren't looking so good, you can see not quite as good. Also, when we look at the earnings per share, 28 beat out of 41, which was good, but we had 10 that missed earnings. And you can see, and Q3 was a great quarter, by the way, for earnings. And it's, I think, might even be better coming up in Q4. I don't know. We'll see. But of the positive, of these 33 that I thought were going to be strong, 31 beat earnings estimates, 2 matched, none missed. Here, of the 41 that I thought looked weak based on relative strength, 28 of the 41 beat, but 10 did miss and 3 matched. So only about 2/3 beat, whereas over 90% beat when we look at the ones that were showing relative strength. So that was the sneak preview. Then we went on to have the Q3 earnings. And what I actually saw here was, as we started getting past some of the financials and into more of the technology and communication services and consumer discretionary, we started seeing a lot more beats on both the ones that were showing relative strength and the ones that weren't showing relative strength. Because keep in mind, not every company can be showing relative strength. I mean, that's impossible. Relative strength, I'm looking at stocks versus their industry group and their industry group versus the S&P 500. Not everything can beat the S&P 500. You can't have 90% of the stocks outperforming the S&P 500. So even if these stocks are doing well, there's still going to be roughly half of them that underperform or not underperform. They're going to be half of them that show relative weakness. And then the other half will show relative strength. Or maybe it's 60-40, 55-45. But you're not going to get 90-10. That doesn't make any sense. So what we saw with 2023 earnings, Q3 earnings, when I looked further and deeper into earnings, we actually went into the early part of November in coming up with these. When I looked at the positive, there were 29. If we look at just taking a look at earnings per share, just to kind of speed things up a little bit here, 24 of the 29 beat, 4 missed, 1 matched. And if we look at the ones that were negative, of the 47, 39 beat, 5 missed, and 3 matched. So that was, the beat was about 80%, maybe a little over 80% on ones that were showing relative weakness. And here we had probably about 83% that beat, 24 out of 29. So very similar results. And I think when I show you the article in just a second, I think that might maybe open some eyes and why the earnings were so strong. Normally what we see are the relative strength at a much higher clip, kind of like I showed you with the sneak preview stocks, than the ones that were showing negative relative strength or relative weakness. So relative strength, in my opinion, is probably one of the best indicators as to whether a stock you're holding is likely to beat earnings or not. That's why I pay such close attention to it, because holding into earnings is always, it's fraught with a lot of risk and skepticism, because we don't know how the earnings are going to come out. We can look at clues and maybe improve our odds, but there is no guarantee. And even if their earnings are strong, you've probably heard the old saying, buy on rumor, sell on news. If a company's about to report blowout earnings, trust me, Wall Street already knows it. They go out, they meet with company management before the quiet period starts. So usually they can talk to management until the end of the quarter. Once the quarter ends, you go through a quiet period until the company reports its results. So at that point, during the quiet period, none of the Wall Street firms should be discussing anything with company management. That would be a violation of SEC rules. So the market anticipates. They talk to companies, they find out what's going on in their pipeline, how they're doing relative to competitors and so forth. And they go back to their office and they decide to buy or sell stocks. And so when you see relative strength heading into earnings, a lot of times it means that Wall Street has met with these company management prior to the quiet period. They like what they're seeing, and we're seeing those companies bought. And so it's not surprising when they come out with good numbers. But buy on rumor a lot of times means these companies get bought up prior to earnings, and then they come out with great numbers or good numbers, and then you see the sell-off after the numbers come out. That's not unusual at all. So just because you have great numbers, that doesn't mean you're going to get a big positive reaction. Trying to determine whether or not you're going to get a positive reaction in the market, I think, comes down to a few more things. Number one, did you have a nice relative strength going into the quiet period? And if a stock has been pulling back during the quiet period, but had great relative strength prior to it, those, I think, provide some of the best signals for maybe a gap up with earnings. Company looked really good going into earnings or into the quiet period, end of the quarter. Wall Street was accumulating. And then during the quiet period, we see a drop off. Stocks pull back, so they're not that stretched. And then their earnings come out. I think you have a better chance of seeing a gap up with that kind of a situation. But anyway, you can see earnings were pretty strong. So let me go ahead and take this down. And I want to show you that article. And in this article, all right, so here it is. This is S&P Global Market Intelligence. You can see spglobal.com, and then Market Intelligence was what I guess you would click on. News, insights, blogs, kind of following that, kind of going along in the website, following that pattern to get to these articles. But this article, this was in the S&P 500 Q3 2023. So this is what we just went over in my spreadsheet. Sector earnings and revenue data. Now, I mean, you could go through and read the article. I'm not going to read the whole article to everyone. But in Q3 2023, look at that number. 80% of S&P 500 constituents surpassed EPS expectations versus the estimates that were out there. 80%. In the prior quarter, quarter two, it was 79%. In quarter one, it was 77%, and well above quarter four of 2022, which was only 68%. So you can see the number of companies that have been beating estimates has been growing every quarter since 2022. And 80% beat in Q3. It's going to be interesting to see how many beat in quarter four. But as I went down and I looked, they actually break this down. I'm going to make this bigger so you can really get a good look at this chart. They break down by sector. So they got the S&P 500. There's your 80%. The gray area represents the beats. The 3% is the matches, and the 17% is the misses. So that's how all of these, so you can look and see which sectors are best by how far the gray comes over. And you can see information technology, number one, almost 90%. You want to know why technology has been outperforming over the course of the last year? And even into the, we saw a huge run up in the fourth quarter. Some of it could have been a result of what we saw in the third quarter. These companies started reporting in the middle of October, and we started a massive rally at the end of October. So, and probably actually information technology didn't start reporting probably, you have a couple of big companies that report early, but you get a lot of those companies reporting the latter part of October and into, throughout November. And so 89% of those beat estimates, 5% matched, only 6% of technology stocks missed their estimates in the third quarter. That's a staggering number to me. And you had so many people going into the third quarter earnings, when they started being reported in October, that kept saying, oh, it's going to be a horrible quarter. It's going to be a horrible quarter. This is going to be really bad. The market's overvalued, because if we take the S&P 500 earnings and then take it times a multiple of 17 or whatever they want to use, they come up with ridiculously low valuations that don't take into account reality. The reality is these companies, more than normal, are beating. And when that happens, future growth is increased, multiple expansion. So not only are you using a higher multiple than 17 to properly value the S&P 500, but you've also got the rate of earnings growth accelerating. So when you start to value these companies, they're worth a lot more than what everybody wants to tell you on CNBC, which is why I don't watch that channel. Information technology, 90% beat. Consumer discretionary, 87% beat. Communication services, 84% beat. Industrials, 83, and financials, 80. The average was 80. The 5 aggressive groups started at the average of 80 and then went up from there. The ones that were missing earnings were everything other than the aggressive sectors. Energy, 74%. Healthcare, 78. Materials, 79. Utilities, 72. Real estate, 52. Now, when I just look at that and I pull up a sector summary and I look for the last year, just looking back over the last year, technology, communication services, and consumer discretionary are by far the 3 best. And they were by far the best in terms of reporting earnings and beating estimates throughout the year. Industrials and financials were next. These were the 5 groups that in Q3 were at or above the S&P average in terms of companies that beat earnings estimates. And then you look down below and you see, energy, utilities, real estate, materials, consumer staples. The groups that don't report very strong numbers, those are the ones that didn't go along for the ride in 2023. They didn't perform as well. And in the case of energy and utilities, we've actually seen, over the last year, pretty significant decline. The environment has been much better for aggressive stocks. And those aggressive areas are overweighted in the S&P 500. So how is the S&P 500 going to go down when you've got the kind of performance and outperformance that we're getting from those areas? So this is the reason why we do this. This is why we look at these earnings and we try to, predict, and we follow up in terms of what companies did actually beat, which industry groups, which sectors have been showing the best earnings results. All of that's really important in forecasting the stock market, going forward. Down here is I think this is the last 4 quarters. So what you're going to see here on this chart is this dark black line, then you've got the red, the gray, and then whatever. Coming across, that's Q4 2022, Q1 2023, and you can kind of see as I point to these, they get highlighted on the chart. Q2 2023, and then Q3 2023. That's the far right. But you can see the S&P 500, the number of companies that have been beating estimates has been going up all year in 2023. Look at communication services where it started last year when it wasn't doing so well. And look at the number of companies, how fast this was rising each quarter. Consumer discretionary has been awesome for the last 4 quarters. Come over here to information technology. Last 2 quarters, we've been almost 90%. All 4 quarters at 80% or above. That's why those companies have been moving for the last year. That's why these companies are crushing the other companies. The ones that haven't been doing so well are the ones that are living below the 80% line, or have been for the most part. Energy had 1 quarter, but 3 quarters below 80%. Consumer staples, again, 1 good quarter back in the 2nd quarter, otherwise not nearly as good. Healthcare, 3 of the 4 quarters below 80%. Industrials, so-so. We had 2 above, 2 below. Materials, 3 out of 4 below. Real estate's been horrible. All 4 below 80%. And you can see this last one, 52%. And then look at utilities. If companies are coming out, they're not beating estimates as often, you're not going to have their multiples are not going to get raised. Their future earnings projections are not going to go up by much. If they're struggling to beat current estimates, why would you raise future estimates? But these other areas that have been crushing, that's where you get raised guidance. That's where you get multiple expansion. And that's where you get higher PEs. There's a reason why many of these technology names carry PEs of 40, 50, or 100. Because they're growing so fast, they're going to grow into them. Anyway, I thought that was very interesting. Now let's move on and take a look at the results thus far this quarter. So I'm going to give you 12 stocks, basically, or maybe 11 stocks that have been that are going to be added. Now, ACCD, I've been telling members, this is actually a stock I took on yesterday as a trade. Thought the gap support would hold at the top, did not. So now I'm dealing with this mess today, which is another reason why I've been trading more ETFs, a lot more ETFs, and fewer individual stock trades, because I just run into this over and over and over again, where it's been much more difficult, I think, unless you've been trading NVIDIA, or some of the stocks that just never seem to pull back. Those are really the individual stocks that you've been able to make money on, those big, large cap names. But you get into some of the smaller names, and it's not been so easy. And again, this one I'm kind of finding out right now. But anyway, this is still a pretty nice reaction. They came out with strong numbers. They beat top line. They beat bottom line. That was the day after earnings were reported. And you can see the volume was the highest volume of the year. It had a nice gap up, and it continued moving up all day long. Stock went from 11.75 up to 15 in one day. So I think this pullback is actually giving us an opportunity. But the top of gap support did not hold, and that was what I was really looking for initially. The 20-day moving average also, we came down about 10 cents below that and closed just below the 20-day. I'd really like to see this thing turn sooner rather than later. Maybe the bottom of gap support's tested, but this is an area where we really need to see ACCD accolade reverse back to the upside. So far, not happening. But I'm kind of giving it a little bit more room than I probably should. But let me go through all of these charts with you, because like I said, there's maybe 11 or 12 of them. The next one is CMC. And what I'm looking at primarily, I'm going to put this in. Oh, shoot, I did something wrong here. I want to fix this now. So I like having relative strength. So I like putting in symbol versus industry. Height 1.0. I updated this right before this webinar, but I think I made a mistake. So I'm going to, actually, it'll be a little lesson here, I guess, on how you can adjust your chart style buttons. So then industry divided by S&P. All right. So this is kind of what I wanted. Actually, I wanted a little bit bigger than this, though. So maybe it's 1,000. That looks about right. All right. So the way you would adjust this, do you see the style button over here? I don't know if it's pops up. It should pop up on your screen. It says upcoming earnings template. This is a template that I like to use. It's in a lot of our chart lists just because it shows me the price action. It shows me the PPO. It shows me the relative strength of the company versus its industry group, and then the industry relative to the S&P 500. So a lot of good information on this chart. And so if you have a style button that's called upcoming earnings template, go down here like you're going to add a new style button. And when you click on that, put in here upcoming, and you'll see it almost immediately, upcoming. And if there's already one there, it'll pull it up for you. So now I pull up upcoming earnings template, and I can replace the one that was in there. So I replace it. And now when I go up and I pull this up, this is what I just changed it to. So anyway, maybe a little stock charts tip there for you as well. But anyway, CMC. So I like this move up with earnings. Came back down. So far, it's been holding this gap. Actually had a nice reversal today. That's kind of what I'm looking for from ACCD, but didn't happen today. Anyway, CMC starting to show some relative strength down here and had a nice gap up, broke out above a recent highs, got an at least in the short term, a nice uptrend in play. So this one will be added, and we'll be tracking this one in the strong earnings chart list that we make available to all of our members. Next up is HELE. This was your earnings right over here. Sideways consolidation, still holding on basically to that gap support. Still above the 50-day. Look at the relative strength, though. Helen of Troy just set a 52-week relative high to its durable household products peers. So this is a stock that's been showing nice relative strength in its group. And when you get these pullbacks, you know, somewhere in the 110, 115 area is where I would expect Helen of Troy to reverse back to the upside. JEF coming out with its earnings in right around that January 8th or 11th timeframe, or 9th, I should say. Had a breakout, but it was intraday. Got a little bit of momentum issue rolling over. This one may pull back, maybe back down to the 37, 37 and a half range. We're sitting just under 39 right now, but that would be an area that I'd be looking for support on JEF. ACI gapped up with earnings, and it's been coming down. Now it is now printed 1, 2, 3, 4, 5 consecutive days of lower highs. I wouldn't be interested in this stock until it reverses that trend. I need to see a higher high go in on a daily chart. Until I see that, I'm really not interested. Maybe if I gap down and I print like a bullish engulfing candle or a piercing candle, or maybe, you know, gap up in the morning, but then sell off intraday with a long tail and then come back, print a hammer with a long tail below. I mean, something like that might also get me interested in a stock like this. But clearly the downtrend's in play until you can confirm a higher intraday high, looking from one day to the prior. AYI. Another one that came out with big numbers, good solid reaction there, nice hollow candle. I like that. Gap support, top of gap support and bottom of gap support will be the two levels to watch. The longer it stays up here, the more, to me, the higher the probability that the top of gap support holds. So that's what I'd be looking for on AYI. KBH. I hope I'm not losing my internet. I did that earlier. There we go. KBH, you can see nice move there in December. Here was the earnings coming out over in here. Tried to break out, false breakout. Now we're pulling back down. I think probably somewhere in this 57 to 59 area. I'd be looking for support on KBH. INFY, another one that's broken out with earnings up in here. Be careful maybe if we get a island cluster reversal. We had the gap up. Now we're kind of in this cluster. If we were to gap down back down below, say 19, that would leave that on a, up on an island. And that could lead maybe to a 20-day test, possibly a little bit lower. But I do like INFY. I think this one, again, with that volume move coming up, and taking out the recent highs, I think that's a pretty big technical breakout there. BK, this is Bank of New York Mellon. Gap up. This is another one that possibly could be an island cluster reversal. But I like what's happening. I mean, look at that relative strength relative to asset managers. Asset managers really were strong in the fourth quarter. So, the fact that this is now one of the stocks that is trading at a 52-week high relative to its peers, if I'm right, and the financials do perform well in 2024 and the small caps start moving, not that BK is a small cap. BK is actually a pretty large cap. But this is a stock I think with a strong financial group in 2024 is likely to do well. BlackRock, BLK, sticking in the financial area, another asset manager. This one didn't get the reaction with earnings that we saw with Bank of New York Mellon. But we are still in a, coming off of this huge uptrend where we saw just nothing but accumulation, really. And then pulling back, we saw a breakout from 740 over here, maybe around 760. So I would say 740, 760 is your key area of support, and that 50 days right in between there. Last two I have for you, UNH. Now, UNH had a big gap down, but all the way up until December, this was a stock or a industry group that was performing really well relative to the S&P 500. It's pulled back, which is concerning, but I'm kind of watching this area of support. With earnings, it went down below the December low, but it didn't close there. So there's a chance that we've moved up, showed relative strength, and that this is simply a period of consolidation before UNH goes higher. So this is one I definitely want to watch. That's why I'm keeping it on, why I'm going to be including it, I should say, on the strong earnings chart list. Last one I have for you here is WFC. This is Wells Fargo. Beautiful move up in December. Earnings just came out recently. We did pull back after the earnings, but it could be nothing more than a buying on rumor, sell on news. Here you can see that we broke out above about 46.5, and we're trading right in that level right now with the 50-day moving average just below at 46. So I think this is a key area for Wells Fargo. I actually like, on this pullback, I'm just waiting for a signal on these banks, but a reversal would be the first thing I look at. I mean, if you look here, most of this move down in Wells Fargo has been gaps. We have a little bit of a red-filled candle there, but look at these other candles. They're almost all either flat or hollow, like dojis, where they close right about where they open, or they reverse and they actually open above the they close above the open. And the open in many of these instances is a move to the downside. So it's, in my opinion, manipulation. We're getting those gaps. We're not really seeing distribution. Distribution has to take place during the day. You can't, if you're an institution and you want to sell 1 million shares of Wells Fargo, you can't do it in pre-market hours. And you certainly aren't going to do it at the opening bell when the market's not very liquid. You put $1 million order in to sell. That's not the way institutions get out of shares. Institutions use market makers, and their job, market makers have a job. Their primary responsibility is to provide liquidity for the market. Maybe the second, reason that they're in business is to try to get the best price possible for their institutional clients. And they do that. Hey, if these stocks gap down at the open, we're going to start thinking, oh my gosh, here we go again on banks to the downside. And it's going to trigger some intraday selling in the morning. And then market makers can use that weakness to accumulate shares for their institutional clients. So if we move down and we see a lot of big red candles, that gives me, look back over here, Wells Fargo. In March, when we were having all the issues, you see a lot of big red-filled candles. That was like the real deal moving down. This is not anything like that. This is just a little bit of gap down followed by, pretty much equal action, buyers and sellers throughout the day, maybe even a little bit favoring the buyers by the end of the day with these hollow candles. Anyway, Wells Fargo is another one I like. And those were the stocks that have reported so far that I, look at and think have had pretty nice reactions. All of these I just showed you beat Wall Street estimates top line and beat bottom line. So when we're talking about the 80% of companies that beat estimates, that beat earnings estimates, these would all be part of that. I personally, because I know earnings drive market values along with interest rates, that's why we keep a strong earnings chart list. We do the research for our members, so our members can look at that chart list and know that every single stock on that list, those companies beat earnings expectations. They also beat revenue expectations. So that is so far Q4 to date. Some of the companies that I really like. And so now what I'm going to do is go through upcoming earnings and give you the stocks there. So let me see where I have those listed. Trying to think if tell you what I'm going to do rather than go over the charts. Let me go over one or two of the charts to show you what I look for in terms of these companies, in terms of their relative strength. So let me pull up a couple of these companies first. And then I'll show you the Excel spreadsheet, and then we'll wrap this thing up. 4 minutes. I'm going to do it in 4 minutes. So one stock on the list would be like Travelers. So when I pull up Travelers, I see the price action going up. But here's what I like more, is that the relative strength, Travelers relative to property and casualty insurance companies, showing a lot of relative strength. And we bottomed on this entire group relative to the S&P back in July. Went up, put in a high, pulled back. Looks like we put in a higher low. And now we're moving back up again. We're trending up. The stock is trending up relative to its peer group, and the peer group is trending up relative to the S&P 500. So we've got a leading stock and a leading industry group. So this is why I believe Travelers is going to have a really nice report when they come out with their earnings. And they come out with their earnings Friday before the bell. So today's the 17th. They come out on the 19th before the market opens. So now, is that going to result in a gap up? That I can't tell you. We've had such a huge run. There's a lot of buy on rumor here. I could see a really good report, maybe a gap up, and then kind of a move back down, maybe a bearish engulfing, and go back maybe and test that 20-day moving average. And then it might be poised for another pushback to the upside. But that would be maybe the most, if I had to put odds and percentages on different scenarios, that's what I would suggest. I think the highest odds are that we're going to get a really good report from Travelers, probably going to gap up, and then my guess is we see a sell on the news. I mean, there is a little bit of a negative divergence on this chart, by the way. So maybe it doesn't even stop at the 20. Maybe it sells off perhaps down into the low to mid 180s, which would be maybe about a 6-7% move from where we are right now. Wouldn't be outrageous considering how far we went up in such a short period of time. And now let me show you one that didn't look so good to me. And I'm not expecting big numbers. SLB, Schlumberger. Of course, this is in the energy area, which has not been strong. But this is a stock that's been downtrending. While the market was going up, Schlumberger was going down. Look at the relative strength, Schlumberger versus its oil equipment and services peers. I mean, literally just within the last month or two, we've been, threatening to break down to a 52-week low on a relative basis. The group itself is already down at a 52-week low. So the peer group is already bad. And Schlumberger, relative to the peer group, is down near a 52-week low. Volume trends are weak. I mean, if they're going to come out with blowout numbers, Wall Street certainly isn't buying into it because they haven't been accumulating stock. So this is, and you can see on this one, we do actually have a lot of big red filled candles. If anything, it looks like these gaps to the upside are just gaps. There's no real staying power. There's no real buying This is the opposite of what we're seeing in a lot of other areas. So we'll see how Schlumberger reports, but that's kind of how I looked at it. So now what I'm going to do, last thing, is I'm going to quickly show, and it has to be quickly because I only have about 30 seconds. But here is the sneak preview and what I've done for this quarter, Q4. So this is my Q4 earnings. Well, that'll be next webinar next week. But here's what I came up with, sneak preview. These are the ones that I think look pretty good going in. I mean, a stock like Logitech, LOGI, that one really looks good. I think GE looks really good. Verizon, surprisingly, looking really good. We do have Netflix next week. I think that one favors moving up. Learn, LRN, is really a strong one. But you can see also there are going to be some banks in here. And banks, I don't think their numbers have been bad, but the reactions haven't been so good. I think a lot of it's because we had such a big run up in the fourth quarter that now we're getting a lot of sell on the news with these banks. But I don't think their run's over. We'll see. It's going to be really interesting to see maybe over the next week or two as more and more banks report, to see maybe if we start to see positive reactions in terms of price movement. But that's really, and then I go down here. These are the negatives. You can always come back and take a look at these. But you can see some of these are banks, but the banks don't look as good. They've been trailing their peers. MTB's been trailing its peers. Regions Financial, RF, been trailing its peers. And then you come up here and some of the other banks, OZK, Ozark, I think that one looks pretty good. FITB, Ally, Bank of Hawaii. There's probably a couple others. East West Bancorp. Anyway, there's a number of them on here. We'll see how they report. The ones that are showing relative strength are the ones that I would have more confidence in terms of them coming out with strong numbers. So next week, that's a members only Q4 earnings. We'll go over all of these next week. I'll track and see how many of these came out with good, that beat versus missed, and see if we, nailed it, or maybe if we need to go back to the drawing board. And we'll also see how many of these total just beat. I mean, did we see 80% or more beating that looked positive going into earnings? How about the ones that didn't look so great? Are we going to see 80% of those go up as well? Because if so, I can't see the market pulling back down much. I mean, if all we're getting is beats all over the board, I'm not showing any rotation that is suggesting that we're going to head into a recession. So I think these are going to be key. I think this, following earnings, we already know interest rates are probably going to favor the bulls. But the question is the economy going to be strong enough where we're seeing beats across the board like we did last quarter? If so, I wouldn't be expecting too much in the way of selling in Q1 of 2024. But if we don't see as much, then maybe we've got chances for a bit more selling in the first quarter. So anyway, I hope you enjoyed it. I really appreciate everybody coming out. I don't know, John, if we had any questions, but I'll be happy to take a stab at one or two if we have them.
Oh, the other thing I would like to add, because somebody asked the question, how does this session differ from next week? Well, you partially answered it. But the other thing is, a lot of companies will be reporting, next week, and then the subsequent week or two, and Tom will be highlighting some of those upcoming earnings. So we got some big names coming up, after next week. And that will be open to members only, including anybody who signs up for a trial. So you can go to our website, sign up for a 30-day trial. That'll get you access to that event as well. Okay.
Yeah, I would basically say same thing. I mean, next week, earnings season, the number of companies is really going to begin to accelerate. So I would expect that we're going to have a lot more companies that we'll talk about, and we'll be able to give you early results from the sneak preview that we did today, which we didn't do today. I mean, obviously, I showed you some companies that I like that have reported so far, but for the most part, we're very early in earnings season. And so it'll be our first look at what's actually transpired, taking a look at these companies. I mean, we got 21 that I'm looking at that were positive, 10 negatives. That's 31 companies that we're going to be able to at least start to make some early conclusions about what's going on in earnings season. And then, like John said, many of the really big names. So if you want to know what I think of Apple or Microsoft or some of these other really big names, what they're looking like, they're going to be included as part of next week's earnings outlook or, earnings webinar as well.
All right, just one general question, more pertaining to the market, more an observation, wanting your thoughts. He said, I see QQQ as MACD crossed up today. S&P hasn't yet. Will the S&P catch up and have the MACD cross up soon?
Well, I'm looking at the PPO on the QQQ, which did not cross up. Remember, the MACD is based on dollar difference. PPO is percentage difference. I actually like the PPO a little bit better, but I'm pulling up the MACD on another chart on another computer. I'm not seeing it cross up. I don't know, when you say cross up, it didn't go through its trigger line. The MACD did not go through its 9-day moving average, which is the trigger line. So I'm not seeing a cross up there. I don't see one on the spider. I certainly don't see one on the IWM. That's been trailing below that trigger line for quite a while now. But all three
he is
do have.
clarifying that he uses the weekly, the WMA instead of the EMA.
Okay. Weekly moving average. So let me pull up the QQQ on the weekly. There we go. Hopefully that didn't get cut off. But yeah, the QQQ on the weekly, that went back up above about a month and a half ago. It's been up. But if you do notice on the weekly, there's a negative divergence where we've seen price action move higher here over the last month or two compared to back in July. And the PPO and the MACD are both lower. So if anything, I view that much more bearish because of that. And the fact that on the SPY, we're right up against all-time high resistance, which comes with a negative divergence on the daily chart and a slight negative divergence on the weekly chart. Although I could go into that. There's some other things it's not as bearish maybe as it sounds, especially on the S&P 500, but I'd need to go over that another day and spend a little bit more time. But I do want to go ahead and wrap up here. But I get your point. I know, it does look like the momentum short term is maybe strengthened a little bit, but there are definitely still some issues on momentum as far as I see it. So go ahead and wrap up. Are you good, John?
Let's go ahead and wrap it up.
All right. Sounds good. Thanks again for everybody for showing up. If you like this, I'm telling you, we do so many things for our members. Take out a 30-day trial and just check us out. Let us help you get through the month of January, even into the middle part of February. There's a lot of signals that period provides us as far as the overall market, and you can follow it with us for the next 30 days for free if you're new to Earnings Beat. And we'd love to have you. If our service isn't for you, hey, don't stick around. I want folks who believe that, our service is going to work well for them and with their style. So anyway, everybody have a great evening. I'll be back tomorrow morning for the next Trading Places Live. Also, I want to mention tomorrow night, and this is for members, also including trial members, you can come in to find our portfolio draft, our model ETF portfolio draft, which occurs tomorrow evening. So that's a pretty big event because our model ETF portfolio, I believe, has now beaten the S&P 500 in like 4 of the last 5 quarters, or maybe 5 of the last 6 quarters. We've done a really good job with that ETF portfolio. So you might be interested in that if you like to trade ETFs. Anyhow, have a great evening, everybody, and I'll see you in the morning. Happy trading.